Introduction to Forex Charting. Types and tools. Forex charting is a crucial aspect of technical analysis in the Forex market. It involves the visual representation of price data over time, allowing traders to analyze historical price movements, identify patterns, and make informed trading decisions. There are different types of Forex charts, each with its own advantages and a variety of tools that traders can utilize for effective chart analysis. Let's explore the types of Forex charts and the tools commonly used in Forex charting. Types of Forex charts. Line charts. Line charts are the simplest form of Forex charts. They plot a line connecting closing prices over a given time period. Line charts provide a basic overview of price movements and are useful for identifying long-term trends. However, they lack detailed information such as highs, lows, or opening prices. Bar charts. Bar charts, also known as OHLC charts, provide more comprehensive information compared to line charts. Each bar represents a specific time period and displays the opening price, closing price, as well as the highest and lowest prices reached during that period. Bar charts help identify price ranges, trends, and reversal patterns. Candlestick charts. Candlestick charts are similar to bar charts but offer more visual appeal and information. Each candlestick represents a specific time period and displays the same OHLC data as bar charts. The body of the candlestick is filled or hollow, representing whether the closing price is lower or higher than the opening price. Candlestick charts are widely used for identifying price patterns, trend reversals, and market sentiment. Renko charts. Renko charts are unique as they focus solely on price movements, filtering out time and volume. They consist of bricks or boxes that are plotted based on a predetermined price range. If the price moves beyond the range, a new brick is added. Renko charts help traders identify trends and eliminate noise caused by minor price fluctuations. Forex charting tools. Technical indicators. Technical indicators are mathematical calculations applied to price data to derive additional information. Popular indicators include moving averages, relative strength index or RSI, MACD or moving average convergence divergence, and Bollinger Bands. These indicators help traders identify trends, momentum, overbought or oversold conditions, and potential entry or exit points. Support and resistance levels. Support and resistance levels are price levels where the market has historically shown a tendency to reverse or stall. Traders use horizontal lines or zones to mark these levels on charts. Support levels act as floors, where buying pressure is expected to exceed selling pressure, leading to price bounces. Resistance levels act as ceilings, where selling pressure is expected to exceed buying pressure, leading to price reversals. Trendlines. Trendlines are diagonal lines drawn on charts to identify the direction and strength of a trend. Upward sloping trend lines connect a series of higher lows, indicating an uptrend, while downward sloping trend lines connect a series of lower highs, indicating a downtrend. Trend lines help traders determine trend continuity or potential trend reversals. Chart patterns. Chart patterns are recurring formations that indicate potential price movements. Common chart patterns include triangles, head and shoulders, double tops, double bottoms, and flags. These patterns help traders anticipate breakouts, trend reversals, and continuation patterns. Fibonacci Retracement. Fibonacci Retracement is a technical analysis tool that uses horizontal lines, based on Fibonacci ratios, to identify potential support and resistance levels. Traders use Fibonacci retracement levels to determine areas where price corrections may end and the original trend may resume. Conclusion. Forex charting is a powerful tool for traders, providing visual representations of price movements and patterns. Understanding different types of charts, such as line charts, bar charts, candlestick charts, and Renko charts, allows traders to analyze price data effectively. Additionally, utilizing technical indicators, support and resistance levels, trend lines, chart patterns, and Fibonacci retracement enhances the accuracy of chart analysis. By mastering Forex charting techniques and tools, traders can make more informed trading decisions and increase their chances of success in the Forex market.